Hey everyone, this is Kevin and thanks for joining. So in my last video, we looked for a profitable property in Raleigh, North Carolina. And I got a lot of feedback and thank you for all of that. But I got a lot of questions related to my buy box and if I could deep dive into some of the metrics that I use, especially related to those more advanced investor related metrics. So in this video, we'll go and review the buy box again and go into greater detail on those metrics and what I think about them. Once again, this is for educational and entertainment value only. If you want investor advice, please see your own CPA, accountant, CFP, or tax professional. This is just for entertainment, but I hope you enjoy this video and let's dive right into it. Thanks so much. Okay, so we have our buy box open again, and in our previous video, we populated this buy box with properties from Raleigh, North Carolina. And you can populate your own buy box with any zip code, area, town that you're interested in looking. But just for example's sakes, we made this buy box specific to Raleigh, North Carolina. At the beginning or front end of this buy box, you have kind of your property demographics. And that's just your basic hard facts or information related to the property. So we have zip code, general square footage of that property, bedrooms, bathrooms, the built year equaling the age, and then the lot size. I was quite interested by some of these larger lot sizes because that provides flexibility to build ADUs and other things in the future, right? I also created a kind of subjective quality score, and that's unique to me based on, again, in previous videos, you saw me look at the pictures. Some had decks, some had a pool for good amenities and other things like that. And so this really is a note to myself about what I think it would take to manage that property, how quickly I could get a tenant and things like that. So I give it a subjective quality score as I'm filtering out properties to look for as an investment. I also paid attention to days on market. As an investor, I tend to favor properties that have been on market for a little bit longer, that haven't been pulled off market. That indicates to me that there's not a lot of buying interest, and therefore I'm more likely to be able to get a better price on that property. We did write the list price in there, and we came down to the price per square footage. Everyone, as they're doing research in their specific market, should start to become aware of what is the average price per square foot given that zip code. They should know what is a fair price, they should know what is a good price, and they should also know what a premium home would cost in that area based on price per square footage. So that was one that we played around with in the previous video, but one that every buy box should have. From there, we calculated a 25% down payment. We estimated some repair costs. Obviously, sometimes for long-term investment, like a buy and hold, where you're renting out and you're not doing short-term rentals or anything like that, this would vary significantly. In the example that I gave in the previous video, I had to account for appliances or paint, major pieces of work or anything like that. So that would vary significantly. If you're doing a short-term rental, then I would put even more aside for repair costs because you would likely have to furnish more of that home to get short-term rentals. So this could be significant. Whether you title it CapEx or just repair costs, you can title it however you want to, but I tend to bundle CapEx into repair costs because it was basically what would it take to turn around that property to get it rented out. Then you have closing costs. Right here, I have 4.5%. That's relatively high, but what I see to include both title insurance, notary fees, but also cost of closing the loan. And so that's wrapped up in here. So generally, you may see investor websites anywhere only around like 1.5% or 2%, because that's what it actually takes to close based on title, attorney fees and things like that, but they're not including the loan fee and things like that. And I have bundled that into this cost here. So I put that into closing costs because that leads me to my next column, which is total cash. And total cash is just what you will need cash on hand to make that purchase relative to the purchase price. So this is the total cash, and this is a big one because obviously it's calculated into some of the investor metrics, as we'll go into a little bit later in this video. We talked a little bit about total cash. That kind of leads us directly into the loan amount. This is a remaining balance of the purchase price. Sometimes you don't need a loan, sometimes you do. That's pretty straightforward. I mapped out to a 30-year fix, so that's 360 months with current today's interest rates. Today being June 9th of 2026. This is investor interest rates. I think that's a quite high interest rate. You probably could negotiate a much better interest rate than this right now. I know there are some states or some lenders, particularly like Lennar has reached out to me through email, giving much more competitive rates, but I wanted to be fair, and in the previous video, we just asked Gemini, and it gave us this rate. So picking an interest rate where you can estimate, being realistic, not too favorable, but realistic an interest rate. And why do I say all that? Because this leads us into the monthly expenses portion of the buy box. And this is huge, right? So you will need to know your mortgage rate, your loan rate, your cost of capital, however you want to call it, but your monthly principal and interest rate. These were all North Carolina properties. As I said, I have property in Raleigh, North Carolina. I am a landlord. All of these properties were relative to the properties that we were looking at. So I pay about $74 a month for landlord insurance through Steadily, which is not sponsored on this video. So I put that in there because I kind of just know the insurance cost. In fact, the property I own is a 4-bed, 3.5 bath, 2,200 square feet. So it's actually much larger than most of the example properties that we picked here, and nicer. And so I definitely think insurance is a little bit overinflated when we did that Gemini search yesterday. But here we are. Next we have taxes, right? This is tax rate based on Raleigh, North Carolina. So about 0.9%. And then we have property management fees, HOA fees, repairs, and vacancy. So all of these are pretty straightforward things you would have to account for, and that gets you to your monthly total expense, including the mortgage. Times that by 12 gives you your annual net operating costs. And then following, we have our estimated rents. So what is our most likely rental rate that we would get? Times that by 12 gives us our gross annual rent. Now we get into kind of the investor metrics that I know everyone is watching for. And so these are really the group of metrics that I pay attention to when evaluating whether I should invest in a piece of property or not. All that information, all of those pieces of input or data was necessary to get to here, right? So a lot of this is data, but you don't really have those key pieces of information yet. One of my coworkers used to always say we can be data rich but information poor. And so these columns right here really help you parse through that data and get to those key pieces of information. Basically asking questions like, will this property be profitable or negative? So I'll go from left to right, and we'll start with monthly cash flow. Monthly cash flow is a nice metric because it basically tells you how much money you'll be earning on a monthly basis. And for someone like me on my financial freedom journey, who basically lives off monthly cash flow from my passive investments, this almost determines my monthly budget based on my portfolio. This is not looking at my portfolio, but this number is significant to me because I actually need it to replace my W-2. And so in these examples, all of these are negative except for the pro forma example that we created here. And it's basically just subtracting monthly rent or total expenses from monthly rent, and that gives you straight monthly cash flow. Again, this total expense included our mortgage, interest, taxes, insurance, and everything that we could think of, including property management, vacancy, and repairs, and that got us to our monthly cash flow. Then we go over to annual cash flow, right? This is just this number times 12, and this tells us the monthly return or the annual return we'll make on that investment. It helps us calculate a lot of downstream metrics or investor-led metrics. So it helps us because most of these will be evaluated on the annual number, not the monthly number. Again, this is a little bit interesting, or not a little bit, this is very interesting to me because I am trying to replace my W-2 wage, and I am looking at a total annual income for my financial freedom number. This really gives me how much of this property is going to contribute to that or take away from that. In this example, unfortunately, we found a lot of alligators, and so many of these are negatives, and many of these I would not invest in. But continuing on to the metrics, right? We have gross yield. Gross yield is one that really tells you kind of your bang for your buck, right? So it takes your rental income, your gross annual rents, divided by the purchase price, right? So if we look at the gross annual rents divided by the purchase price, this really tells you how much yield out of that property are you getting. Being higher is better. And so you really want properties that are yielding really good rents relative to the price that you're putting in. And what does this tell you? So in areas like Raleigh, where we're looking, right, like potentially this property may cost a little bit more, but it just doesn't yield as much, meaning it just doesn't generate enough a lot of revenue relative to some other zip codes or some other properties. So this is more of a trend metric that you should pay attention to. It's not one I make a lot of decisions based on, but it gives me a little bit of insight, a little bit about the area and how much yield I'm actually making off of a given piece of property. Next, we go into expense ratio, and this is one that I just monitor. I don't really pay attention to, but it tells me a little bit about what is my expenses relative to my rental rate. So I'm taking the annual rent rate divided by the net expenses. So if we look here, we're taking the annual rent rate divided by the net expenses. In this case, if it's over 100%, the expenses are outpacing your annual rent and you have a loser on your hands. Ideally, you want somewhere in the 35 to 45% for the Bay Area. I should mention that, right, this is my template, even though we filled this out together for Raleigh, North Carolina, because I have property in Raleigh, North Carolina. I am from the Bay Area. I started investing in the Bay Area, and my targets are generally focused for Bay Area returns. So this is just through experience, through AI. I know that my operating expenses for a given property should land somewhere between 35 and 45%. Right now, we were not able to find any property that landed in that. So like I said, this is good to monitor because you don't want it to float, and it can fluctuate year over year. You may want to make copies of this sheet and monitor the progress of that property year over year and make sure you're still achieving a given expense ratio. If your expenses go too high, then it may be time to flip that property or do something else with that. So it's an interesting metric to monitor, but not one that I generally make a lot of decisions on, but it is a nice to know to keep track of. Something that I pay more attention towards my P&L statements. And so maybe in the future we'll go over what a P&L looks like, and I do have certain target metrics at the end of the year when I create the P&L to say whether that's interesting or not interesting. Okay, next we have NOI, and this is an interesting metric that gets a lot of attention and one that I am not a humongous fan of, but still one that you do have to pay attention to. And why is that? So NOI is your net operating income. You would assume it's your income, but not really. It is the income minus the net operating expenses, but it's not all operating expenses, and that's what makes this metric unique. And so net operating income is your gross annual rent minus your total expenses, but not including your mortgage. right? So how, let me see if I show that. So yeah, it's your net operating income minus all of these except for your mortgage. And why do people look at NOI? Why is it talked about? Why is it discussed to such a high degree? And so to elaborate on the mortgage and why it's not included is because the mortgage can be different from investor to investor, or that access to capital and that cost to capital can vary greatly, right? You could use a HELOC, you could use a DSCR, you can use a personal line of credit. Some people even use credit cards or other things like that, right? So that monthly mortgage or that credit amount or debt servicing can vary significantly, and it can throw off your numbers quite wildly. So NOI is a number to communicate to all investors what is the net operating income minus that access to credit or access to capital. And the reason why that's interesting is because it generally doesn't move too much from investor to investor. It is relatively fixed. Now, I say relatively because it's not 100% fixed. One person may be able to get better property management than another person, but mostly it's going to be very close. It's going to be very similar, right? Taxes don't move. Insurance is relatively going to be same for a given market. Same with property management. HOAs are going to be the same. So you minus all that from annual rents, and that's how you get your NOI. And again, this is interesting because it doesn't change from investor to investor. So when you tell someone the property has an NOI of, let's say, 20,000, that automatically tells me there's some buffer or margin in there if I were to minus access to capital. If the NOI is kind of low, then I don't have much margin given what it would take for me to raise capital or things like that. And so that's why NOI is a very useful metric. It's not one that tells me a lot of information on whether the property will be profitable upfront or not, but it does tell you relatively to other properties how well that property will perform, right? So I just know this NOI is better than this. Given all the other information the same, if my cost of capital was fixed, like at 7%, 30-year fixed mortgage, I would obviously pursue the one that has a higher NOI. So that's why NOI is a relevant metric, one to pay attention to, but not one I make a lot of decisions on. Next, we have cash on cash return. This is probably my second, you can see my rankings here, relatively high metric on my scale, one of my more favorite metrics. And why is that? Cash on cash return is basically your annual cash flow divided by the cash that you put in to acquire that asset. And so it is a ratio. Again, let me click on that calculation. So it is, again, your annual cash flow, positive or negative, divided by the total cash that it took for you to acquire that asset. So if you think about stocks, if you think about CDs or anything, you can do that for any asset, right? You can take your annual return divided by your cost basis or anything like that, and you can back calculate your cash on cash return. Again, this is interesting to me because it is specific to the investor. So different from NOI, cash on cash return takes into account your annual cash flow. Your annual cash flow took into account all expenses, cost of capital, meaning your loan, any interest payments or anything like that, divided by the cash that you put in. So like buying a stock, if you bought a stock at $50, that's the cash that you put in per share for a single share. And if you return $10, then that would be your annual return, right? And why is that significantly interesting? It is specific to me, so I will know from this number whether I'm making money or losing money. It also tells me the rate of return that I'm making on an annualized basis, right? So in this instance, this property was the only property that we found that may be profitable, given our various scenarios that we modified to make it profitable. And even when we modified the scenario, we're still only making about 2% cash on cash return. And why is that interesting? Because today you can go to a bank and buy a CD that has relatively no risk at all and get a 4% return. right? Or you can put that money into a high yield savings account and get a better return on this. So without doing any work, right, you could get a better return than what this investment would be just on the open market, right? And so this gives you kind of an apples to apples comparison about how well your investment is performing. If you think of ROI, this is right up there, and this is what is my return on investment metric. Obviously, these are poor numbers, and I wouldn't really touch any of these as investments, but this is just for example sakes. Again, in the Bay Area, what is a great return is 5 to 7%. You would likely never, or it'd be extremely hard to find that in the Bay Area, I'll be honest. In other locations, I would expect somewhere on the 5 to 7% for me to really make a move to enter a different zip code, right? Because certain things are not captured in this worksheet. Different tax implications. You would have another filing when you enter another state. You would need to build a network to go into out of state and things like that. So really, in order to make a return, it really needs to be worth it. And that's why I put a target of 5 to 7%. All right, next is cap rate. And cap rate is another very interesting one that I like to look at, but not one that I ranked very highly. And so that may be a little controversial, but again, why do people look at cap rate? Let's go over that formula really quickly. And that's using the net operating income divided by the market price or the overall price of the asset, right? So if I go way over here, we're looking at the price. And why are these two numbers interesting? So again, it used NOI. And again, NOI does not change too much between investor to investor. So it's relatively a fixed number. And same with the purchase price, right? Most people will not be able to get a significantly different price than what is listed on the open market, right? You may be able to negotiate that down. Cool, you'll get a better cap rate. But same with like stocks, right? You have stocks listed on the market, you have an ask and you have a bid. Generally, you're going to be close to that number, right? And so why is cap rate interesting? Because when you look at NOI and price, again, those don't really change from investor to investor. And so this gives you a quick number you can use to evaluate whether that property is going to be profitable or not. I will tell you, the Bay Area, 3 to 5% is an average cap rate. If you can get that, that's actually not a bad deal in the Bay Area. You most likely will not be profitable, but there are other reasons why you may want to buy property. In this instance, I like to be well above 4%, right? Because you can have a positive cap rate and still a negative cash on cash return. So the farther you're away from that 4% kind of cap rate, though that's what I would call like a real skinny deal. You don't really have a lot of margin. I would generally stay away. But cap rate, what's interesting about cap rate again is it doesn't change too much from investor to investor. And that is why a lot of investors will mention cap rate and NOI, because those are metrics that are relative to all products and relative to all properties. So I can quickly tell you, hey, this has a cap rate of 7%. That automatically tells you, hey, that might be worth investing in because I most likely can make it cash flow. Versus if I told you, hey, this property has a 4% cap rate, that may not be a great investment right away. You can tell that because you don't have a lot of margin to make, a lot of margin on the NOI, sorry. So that's cap rate. And then lastly, we go into DSCR. And now this is a metric that a lot of people won't pay attention to. I pay attention to it because I don't have a W-2 job right now. So what is DSCR? DSCR stands for debt service ratio, and it is relative to a specific type of investor loan that I like to use and that I have access to. So, and most people will have access to. It is a non-qualified loan or non-qualified mortgage, or QM, people will say that. And so what does that mean? So normally a loan, you need, like a conventional loan, you need income, employment history, you need a high credit score, and the bank is taking a bet on you, the person, to be able to pay them back, right? A lot of that's based on employment history professional field, and credit score. I have an awesome credit score, but right now I've been unemployed for almost 2 years now, working on my financial freedom journey. But it would be it's really hard for me to get a qualified mortgage right now. However, I have access to DSCR because DSCR is different. The bank only looks at the performance of the property. These are investor loans because these are meant to be loans given out to investors who will rent out that property and make a positive cash flow to carry the loan. So what is DSCR? DSCR is the annual rents divided by, the monthly rent divided by the total expenses. So here, it's very similar to, or it's almost the exact opposite of expense ratio. Here, you want to be greater than 1 because most banks won't approve your loan unless you're greater than 1. Historically, I think it was floating around 1.2. You needed to be greater than 1.2 to obtain a DSCR loan. I know more recently in 2026 that's changed. Sometimes they get looser on that ratio. Sometimes they get tighter on that ratio. Meaning tighter, meaning you need to be higher than 1.2, or looser, meaning you can be lower than 1.2. In this instance, most of these homes don't even carry the cost of the loan, meaning you're upside down or you're negative just paying the loan and expenses that they're aware of, and they wouldn't even give you a loan. In this instance, you might pass because the bank knows you're profitable in one instance. And so they might approve you for DSCR loan. This is one that I pay attention to because if I can't qualify for the loan, I'm most likely myself not able even to make that purchase. And so this would automatically discount a lot of properties for me in selecting properties to invest in. And this is why I pay attention to that. I don't pay attention to it too closely all the time. As you can see, I rank that a 6, but I do pay attention to it because if you need interesting financing, it is something to pay attention to. So in summary, these are kind of the investor metrics that I pay attention to, and I've ranked them up top right here in what I find is most interesting. These are reminders to myself of what I pay attention to. And I've also created targets for my local area. I totally suggest everyone create their own buy box and get familiar with these metrics and familiar with these formulas. Again, I pay most attention to annual cash flow, which is relative to monthly cash flow, and I love cash on cash return. Those are kind of the big ones that I pay attention to. And, these are the overall metrics that I look at as an investor. I really hope you enjoyed this video because we will use these metrics as I continue to look for profitable properties across the nation. So thanks for joining, and catch you on the next one. Thanks. Bye.